Today, I'm going to break down one of the craziest financial stories in America, Las Vegas, the land of neon dreams, high rollers, and billion-dollar bets. But what if I told you that today, the real game isn't being played on the casino floor, it's in boardrooms, on spreadsheets, and behind closed doors. Billion-dollar buyouts, financial engineering, casino giants drowning in debt, and profits that soared even as the companies collapsed. This is how Wall Street bought the Las Vegas Strip, so let's get into it. So today's story started in 2006. Private equity firms Apollo Global Management and TPG Capital made an absolutely monster move. They bought Harrah's Entertainment, the world's largest casino operator, for $27.8 billion. Now, you might assume they just wrote the check for $27 billion, but they didn't. It was a classic leverage buyout. Now, this is how it worked. Only about $6 billion came from Apollo and TPG themselves. That was their skin in the game. The rest, over $21 billion, came from borrowed money. Now, look, we're talking massive loans from banks like Bank of America and Deutsche Bank, junk bonds, which is high interest debt sold to investors, and something called mezzanine financing, which is basically risky debt with even higher returns. So all of that debt was placed on Harrah's books, not Apollo or TPG's. It's like buying a car, making the dealership co-sign the loan, and then walking away with the keys. Now, just 2 years later, boom, the 2008 financial crisis hits, tourism tanks, Vegas dries up, Harrah's, now rebranded as Caesars Entertainment, is stuck with over $25 billion in debt and shrinking cash flow. Now, for years, they scrambled to stay afloat and keep their head above water, but by 2015, Caesars operating company filed for bankruptcy in one of the largest restructurings in American history. Employees lost pensions, creditors got pennies on the dollar. Meanwhile, Apollo and TPG were accused of moving valuable assets to new entities before the collapse. Now, here's where it gets even more interesting. After the recession, private equity firms didn't just walk away, they just changed the game. Instead of buying everything outright, they started separating casino operations from the real estate. It's called sale-leaseback, and this is how it works. One firm, usually a REIT, buys the land and the buildings. Another firm operates the casino and pays the rent to the landlord. Now, this model reduces capital risk, locks in predictable cash flow, and lets PE firms extract the dividends faster. Welcome to the real estate takeover of Las Vegas. In 2021, Las Vegas Sands sold the Venetian, Palazzo, and the Sands Expo Center for $6.2 billion. Apollo financed their end with $1.7 billion in loans and bonds and a small chunk of equity, and within 18 months they paid out $620 million in dividends to investors. The Nevada Gaming Control Board even flagged it, asking how is it possible to extract that much that fast. That's how powerful this model had become. Now, if we go back to 2014, Blackstone bought the Cosmopolitan for $1.8 billion and invested $500 million in renovations. 7 years later, they flipped it for $5.65 billion of profit, which is the most profitable single asset deal ever. They used the same structure. MGM got the operations, REITs including Blackstone Real Estate got the land, and Blackstone exited with billions. This wasn't gambling, it was financial engineering, and it paid off. Now today, most of the Strip is controlled by just a few players: Apollo, Blackstone, Vici Properties, and a few REITs like Stone Peak. Caesars, MGM, and others now operate as tenants, paying hundreds of millions in annual rent on properties that they used to own. So let's break this down to the good, the bad, and the ugly. The good: private equity injected billions into Vegas, renovations, new venues, and a booming tourism followed. The bad: casino operators are locked into long-term leases, which are 30 years or more. They have less financial flexibility and massive recurring costs. The ugly: employees face cuts, layoffs, reduced benefits, and in some cases, the businesses were loaded with debt while private equity firms pulled out dividends. Now, it's not always about building, sometimes it's about extracting. So here's the truth. Las Vegas didn't just evolve, it got bought. The iconic Strip, once built by mobsters, entertainers, and also risk takers, is now controlled by investment firms in glass towers. They don't play the slots, they collect the rent. Thanks for watching, and if you found this deep dive helpful, then please hit the like, subscribe, And also let me know in the comments.